Okay, I think we can begin with our webinar. So once again, we discussed in many of our episodes about club deals, joint ventures, how this work, but we touched also more the side of finance and how this works. And now today we'll try to be a little bit more technical, but in the meantime to not get you bored, guys, because we lawyers, we have a lot of very clever wording which you don't like and don't understand. And today I'll try to explain in very simple language for you also to understand how these difficult agreements work in a project finance. Because, nowadays we have two main, let's say, options of big investments. Either you investors, private investors or even institutional investors, you give money to investment funds, naming big like BlackRock, Vanguard, Blackstone, and the known trillionaire funds. And then you wait for a good yield, or you have a bad sleep and think, okay, maybe my money are at risk, And the second option is you try to pool money together in a club deal with your friends, with your family members, and try to invest this money alone without these big investment funds. And here is the main trick and big legal issue. If you cross the line, which is the red line, between a regulated fund and unregulated, let's say, gray club deal, then you might end up very badly because, I'll give you one example. If you want to establish an investment fund in Frankfurt am Main, Germany, or I believe in any other capitalistic country, you'll need to put aside at least 100,000 euro for compliance, for prospectus, for lawyers, and to make sure that your investment fund is compliant. Why is so? And this is a good part of it because investors, they get protected from different, let's say, multi-level marketing schemes and Ponzi schemes which are trying to collect money from people and then disappear, right? So, but as I explained, if you are in a family member, let's say a family office, then you might consider also investing with your members of the family, avoiding this regulated investment fund, which is very expensive. And to make sure this works, first of all, you need to approach expert lawyers to explain you where is the border and the red line to not cross. Because I'll give you one example. If you go publicly in online and say, hey, give me money, I'll invest it for you, and I guarantee this return and so on, this is very dangerous. This is even criminally liable. So don't do this. This is the biggest mistake. But if you have family members within your big dynasty, let's say, and everybody wants to take a small role in the club deal investment of real estate, someone is doing management, someone is doing, operational, someone is doing, just cleaning, utilities, and so on. And everybody is involved, and there is a clear agreement between you, avoiding any disputes in the future. Then, of course, this is like a zone where you can invest. But even so, you need to have opinion, I would say legal opinion, either from lawyers or from regulated authorities, from the regulation authorities from your country. And if you would like to deep dive in which countries you may not need too much regulations for the investment, for the small investment funds, then I can drop in the comments We have a small research done on it. And there are many countries around the world where you can do this, even a crowdfunding, very easy, and you can access big deals, okay? Because, look, from my experience, many investors and clients from the middle, let's say, up to 10 million euro, they're asking, hey, how can I can, as a middle class guy, how can I access big deals? Because, you know, I explained in my previous webinars, with 100,000 euro or even with 1,000 euro, you can access buildings which costs 100 million euro. How this could be possible? It is possible through so-called sandwich, I call them, or sandwich financing. You invest like 30% of the equity, then you get from investment from mezzanine funds, you have another 30%, and the rest you get from a bank. So it's like a sandwich. So 30, 30, 30, okay? And of course you can get access to bigger deals. But imagine now if you don't access this leverage effect from investment funds or from the bank, it's impossible actually to get access to big deals or big buildings. And why is so? Why actually you need access to big deals? Because the return on equity, of course, is higher, okay? So everything is related to the how much money you get in return from your equity. And if you guys would like to understand how return on equity on investment works with just as little as 10,000 euro, please go to my previous webinar from 2 weeks ago. I also did on Friday, and I explained step by step how you can get from a little investment to a bigger one. Let me just connect this screen, please. So, in my previous webinars, I explained how anyone with as little as 10,000 euro may get a return on equity with around, Chanel, how much was the optimistic scenario? Do you remember?
Optimistic was 400 and something euros.
Yeah, okay, yeah. Per month, right?
Yes.
So, once again, if you would like to see what is my approach on how to get a return, like monthly income, this is your salary, imagine. Everybody will say, no, it's not possible. With just 10,000 euro, you get 400 your salary per month, and it's like passive income. You don't need to work for it, okay? And you may, I don't know, retire and have a passive life, or you can have an active life and continue to make money besides this stream of income, right? So, go if you don't have, Diana or Chanel, if you have the link from our previous webinar where I explained this in a live, how this works, then please share in the chat in Zoom, and people may see how we explained last time. So, this is about previous webinar. Now, today we will discuss a very interesting topic. Today we will discuss about project finance. What is project finance? Project finance is a non-recourse method of arranging, financing, operational, and the whole architecture of investment project in such a way that all parties involved in the project finance, they get their role, the risks are allocated. Guys, please disconnect the microphone for those which connected. So the risks between parties is allocated in such a way that everybody enjoys a very nice risk and reward profile, okay? So what is project finance? Project finance is first of all SPV. What is SPV for those which are not familiar with? SPV is a special purpose vehicle founded and established especially for one project, okay? And later I'll explain you how you can get the risks out of the SPV, okay? So now, in a project finance, you always have people which bring money, right? These people are sponsors, yeah? Limited partners, equity investors, call them as you want, okay? So these people, they pull money together in the SPV with the goal to co-invest with the bank and other participants in the project. Now, in a general project, let's say in a typical project, they might come with 30% equity, and then you have the bank, okay? So the banks usually they don't take 100% risk unless there is a project with different approaches like positive pledge, negative pledge, it depends. But this is, we'll discuss later. Now I'm speaking about a classical project. So investors 30%, bank 30%. Now what is happening? How the money comes to the SPV and how SPV get in contracts with different parties like contractors, construction company, off-takers, governments, yeah? And here I will say this is the host government. Yeah? Here, let's say we have off-takers. Yeah. Okay. And here we have engineering, procurement, construction agreements. Okay. So these are parties of a project finance. Okay. So I would like to make this conversation very interactive and try to invite as many from your side which are interested to ask some questions. Alia, if you allow me, I will interact with you a little bit. So first of all, thank you very much. You find such a short notice time to get in the call. Alia is our representative from United Kingdom, from London. She's a very good expert. She has a lot of contacts with our investors, clients. And yeah, what is your opinion on nowadays approach to project finance? What do you think? Is this tool still working? Are there any adjustment, even with this, I don't know, crazy world with energy crisis and different insurances we need to take on? Do you see any part should take in this project finance in such a way that the projects of the investors are secured?
If you are talking about former Soviet countries, yes, and yes, I think it's one of the mechanisms of securing finance. One of the most popular ones, if of course we are looking at inflow of investment into countries like a lot going into Kazakhstan. Now Uzbekistan is completely booming, and we see like inflow also in countries like Ukraine, because it's also structured through development banks and so on. Yeah, if you ask me my opinion on whether these structures are being used absolutely. Yes, and more in some jurisdictions than the others.
I mean, what do you think about potential instruments to mitigate the risk? Do you see any developments in the, because country risk and war and force majeure is very sensitive topics. Do you think is there any insurance instrument which can cover this risk? Okay, beside the insurance company, from the legal perspective, do you see any legal tools how investors may get protected from I don't know, nationalization or losing the whole investment in a region, for example, how it is now in Middle East and other country?
Some companies structure their projects by using intergovernmental agreements. Sometimes it's right, sometimes maybe wrong. Governments should not be taking, those risks. Assume those risks. But I'm talking about bigger projects. Infrastructure projects. That is a sort of insurance. If you don't talk about
yes, absolutely,
security.
absolutely, yeah. Alia, also you touch a topic which is very interesting. In big projects, you may also have, let's say, comfort letters and direct investment agreements with the state, of course. Yeah, this is great. Also, I would advise clients, investors always to check on bilateral investment treaties and protection agreements of between countries, and to make sure that you can bring all disputes in a project finance to the ICSID court or whatever arbitration court outside of this emerging country, because whenever you have as an investor, you have the agreement with the SPV or with the host government, because what is risk? You know how I call risk nowadays in a simple language? I call risk like something you need to buy. So when you make your cash flow, and let's say you have the return on investments, I don't know, 50%. Doesn't matter which kind of project is this. Is this a real estate? Is it a gas pipeline? Or is this a data center for artificial intelligence? You have a return of 50%, okay? How you make sure that the risks are adjusted in this return? So you price them. So you have delay risk. You begin a project and someone is just delaying your project and saying, sorry, I have short of materials. I have problems with the licensing with the state. I have problems with, I don't know, my relatives and so on. I cannot deliver on time the project, okay? So what you can do, you put on price of it. So delay risk has a price. How much is the price? For example, if you delay the project with 1 day, then you calculate how much cash flow you lose per day, or to serve your debt in the bank, because you need to pay interest in the bank, right? And then you discount and say, okay, for example, you pay the debt every day, interest rate of, I don't know, 10,000 euro, or it depends on the project, might be every month. Then this 10,000 euro, you put it like the price. So the delay risk has a price of 10K, okay? And when you calculate your return on investment, you always make sure you discount this 10,000 from the overall return on investment. So Alia, do you agree with me? So the risks in the project, we need to always price them. Put a price and say, okay, this is the low risk. Then let's assume a country in which you are investing. Doesn't matter, is this Moldova, Kazakhstan, or Uzbekistan? There is a problem with the foreign exchange, It means you invest in dollar or in euro, And then when you collect from the off-takers, when you collect the cash flow, yeah, from the clients, you collect in local currency. And this local currency might be, I don't know, Moldovan leu or how is called in Kazakhstan the currency? What is called?
Tenge.
Tenge. Okay, let's say it's tenge, yeah? And then, but you invested in dollars, okay? And imagine that the exchange rate between dollar and local tenge in Kazakhstan is like very different from the moment you did the investment. So my question to the investor is how you secure this risk of not having another exchange rate and lose everything you made here with 50%, right? How you do it? It's very simple. There is a foreign exchange risk, yeah, which you price. The price of this risk to be mitigated will be the exact amount of how much you pay to have a fixed futures for this exchange rate. So it means you buy in the future. Doesn't matter what happens with the rate between all these currencies, you buy in the future a swap, a future which allows you to sell your local currency at the same rate. Do you agree with me, Alia? So this is another tool. This is another tool.
Sorry.
Please.
Sorry, Gun.
Yeah, please.
I did not understand how you can buy in the future. Can you make like a practical example of this?
Mm-hmm. It's very simple. So there are many providers of even your bank. So you go to the bank, I'll explain it very simply. You go to the bank and say, hey, I'm doing the investment now. Today is May 2026, but I have the fear that in the future this rate might go down and then I will not be able to buy so much dollars. I will need much more local currency. If, for example, in the beginning you bought for €1, you spend 20 lei, Moldovan lei, then in the future you might spend 100 lei for the same $1, imagine, okay? And the bank will tell you, okay, to secure you against this risk, you need to buy this for the futures, yeah? And this is a, let's say, a bankable product from the bank. You pay for it, okay, a percentage, and then you have a fixed rate over the period of, let's say, at least hand over your project because you need to serve the debt to the bank. Yeah? Chanel, it's very simple. You just go to the bank and ask them to sell you this product and you pay a price for it. How much it is, I don't know, depends on the country and depends on the, so every bank. Is that clear?
Yes, now clear, thank you.
Great. Okay, so let's go ahead. What else? What kind of risk we still might have in project finance? What do you think? So besides those delay risk, foreign exchange risk, what other risk? Imagine the investor is building a data center. Nowadays, by the way, I was in the conference of BlackRock and Blackstone, and they presented that in America are built nowadays around 700 or more data centers, and they plan to build in the next years 1,300 data centers. What is this? Data center is like, what we are doing now is this webinar. Everything is stored in this data center. And if you ask my opinion, in the future, offices will disappear 50%. And this is for sure in the next years. And people from the office will work remotely in different villages, with access to data centers. And the role of those people will be taken by servers, okay? This is the future. That's why building a data center, if we have here in the call investors looking at where to deploy money, then think about data centers because this is the future. And now coming back to our project finance, data centers are also built through project finance, okay? Now, how you secure the following risk? You build a data center and then you have a technology risk. Let's say the company which is producing chips like NVIDIA, they say, you know what? We don't have any more stocks of GPU. So what's your turn? So how you secure? Because you need to think about this before even signing the agreement with the bank, okay? Because this is a huge risk. And how you make sure that you cover this technology risk? Chanel, do you have an idea? Like from your perspective, imagine you build a data center and Mr. Jensen from NVIDIA says, you know what? I don't have any more chips for sale. China bought everything. So what will you do?
Oh my God. No idea.
No idea. So therefore, guys, big companies, big investment funds, and professional lawyers, they always think about this in advance. They don't start up the company, they set up the project, and then they think where to buy materials. No, everything should be secured in advance. And to mitigate those risks, you need to make sure that you made your homework, because otherwise there is a risk that you will end up very, very badly. I will just open now one of the agreements which we worked on now, and I will show you the following. Diana, can I share my screen now? I can share, right? Let me see. How do I do this? Okay. So here, do you see my screen? Everybody sees my screen. No, in Zoom call I need to share this in Zoom call, I believe, right? Okay, let me see.
No, you should share on Riverside.
On Riverside? Okay. I cannot share on both, right? Okay, guys, for those of you which are now in Zoom call, you may go on our live, which is Grata International LinkedIn page or Grata International Facebook page, and you will see my screen because it's very interesting. Okay, so guys, here we have just kind of risks involved in the project finance. We have, you see, technology risk, environmental risk, exchange rate, interest rate, insolvency risk, by the way, political risk, okay? And then we have the project, okay? Here is much more complicated. I will not make you bored by this information. I'll explain in very simple wording, okay? And then we have contracts, we have different components of financing, which kind of debt, okay, the risk period and so on. So now, I would like to stop at this page. It's very interesting. Alia, do you see my page well?
Yes.
Perfect, okay. So if you are looking at this page, yeah, you'll understand how much importance has risk in a project. Because you see, in the beginning, I'll just repeat on the table for those of you. In the beginning, let's say you develop a project in UAE. By the way, is Miriam in this call? Miriam, do you see us? Chanel, you see Miriam because she's developing now a project. No, this is not Miriam for sure. Okay, so in a project finance, you have, so here's the money you invested, right? Millions, 10, I don't know, 5, 2, 3, 1, 500, so on. So this is the money. And here you have the periods in years, months, depends, 1, 2, 3, 4, 5, 6, 7, and so on. Okay, this is actually the time to maturity, we call this. So in this time, your investments are growing or going down. So now, when you begin to build a project, you just put the first brick. Then the risk is very high. You go up, okay? You go up. This is the price of the risk, yeah? So in 1, 2, 3, let's say 4 years, you build a project. Doesn't matter, is a building or is a factory or is a data center, okay? And now here, you hand over the project. Here you cut the line and say, okay, you invite the mayor of the city, you invite your clients, investors, friends, and say, here the project is ready. And here is the break-even point of this project in terms of risk, okay? And then the risk comes down. So, why this is very important? Because over the lifetime of the project, you have several problems. Delay risk, technology risk, war, foreign exchange currency, and so on. Actually, I would say that foreign exchange currency is coming later because you begin to have cash flow from the project to serve the debt, okay? Let's say this is environmental risk. You are building a data center and then the community is coming to you with a big class action and saying, hey guys, my river is dirty because of your data center, okay? This is a risk. You need to count. Now, how much this risk costs? Let's say this one, because you need to employ lawyers, maybe is, I don't know, 10K. This one is 500K. This one is 200K. And then environmental risk actually are very expensive. Yeah, let's say is 800K. This is the price of the risk you are taking during the lifetime of building the project. And here is the start of the project, yeah? From this moment, you begin to receive cash flow. Cash flow, yeah? If here the risk brings you down, here you have cash flow, okay? It means the money comes in. Charnel, is very, very understandable what I'm explaining.
Yes, it's understandable.
Okay, so therefore, in this operating phase, so we call this operational phase. Yeah?
I have a question.
Please.
Sorry, if you don't mind.
Please.
These risks, I understand that while you building the project or
Yeah.
Planning for the project,
Yeah.
this risk would be cheaper than when after the project is done. So let's say you're doing a building,
Yes.
the technological risk might be cheaper than when the building is actually done. Also war. Maybe you might face war challenges and the building is completely destroyed, which
Yes.
means that risk in the construction phase, it was cheaper than in the operational phase. Is that correct?
Yes, when you say cheaper, what do you mean by this? This is very important. Why mean cheaper?
I mean,
Because
if the building...
do you mean by the... Maybe this is your point, that the return on investment need to be discounted and then the price of the building to enter as an investor now is cheaper. This one I mean, like an off-plan. Like the price of the apartments will be cheaper here. This one you mean?
Yeah.
Yeah, perfect.
Yeah, that's true.
It's very good question because look, I've got a lot of investors asking me, hey, how is possible that a building in Dubai or in Singapore or in Kazakhstan, they sell off-plan properties for like half of the price and they still have a payment plan? Of course they have a payment plan because they share the risk with you.
Oh, okay.
Do you understand this?
No,
So,
I understand.
yeah, if let's say you have here a building, A huge building. And every apartment in this building is like, I don't know, 1 million euro. So, before the startup phase, the price of this apartment will be much cheaper because of those risks.
All right, makes sense.
Yes, here is like only the foundation. It's only, so the building is not built yet. They just got the construction license. They begin to build, okay? But they have nothing. They just collect money from investors, pull them in an escrow account in the bank, in the optimistic scenario. In the pessimistic, they use the money directly. And then they build little by little. So first year, second year, okay? Third year, and so on. And if you, Chanel, go to the developer and say, hey, I would like to buy an apartment, okay? They'll tell you, you know what? The price of this apartment here is 1 million. But here is just 500,000. What would you do? Would you buy 500 or 1 million?
500,000.
Why?
Because
It's cheaper, of course, it's logical, it's cheaper. It's cheaper. Okay, they even give you a payment plan. It means you pay in the beginning 100, then 100, then 200, and then how much remains, yeah? But you should do your homework before even thinking to buy this off plan. Okay? There are markets around the globe which I trust. For example, Dubai, and in general UAE, is a great place to buy real estate because the risk is secured, the government fulfills their, let's say, promises, and even look what happened now during the energy worldwide crisis, they still manage to do sales, a lot of sales, okay? There are also very secure countries around the globe. But in some countries, before paying this amount of money, you need to think very well, do your homework, analyze all these risks with an expert, with a risk manager, with a lawyer, try to negotiate with the seller, okay, a very good SPV, okay, before giving them money. Because here, you might have 100% return on equity, right? Chanel, how much you have if you buy for 500 and then you sell for 1 million? 100%. It's very attractive. You pay 500,000 and then in 3 years you get 100%, or how much? 1, 2, 3, 4, okay? Let's say we don't have this, yeah? How to erase this? Sorry guys, we just are not very familiar with this table. So, how you make sure, because if you have 4 years, okay, 1, 2, 3, 4, yeah? Then
Yes.
you need to divide this by 4 years, first of all, and then discount by those risks, okay? And also don't forget to discount for inflation, because many think, yeah, okay, this is my return on equity. What if you got in 4 years, you got 25%, right? Yeah, it's 25% per year. 25 return on equity per year. Okay? What if you did not discount for inflation, and inflation in this country, my friends, is 25%? By the way, Aliyah, how much is inflation now in Kazakhstan? Do you have an idea?
Sorry. someone from Kazakhstan could answer that. Then
Diana, do you know how much is in Kazakhstan inflation? Let's ask ChatGPT how much. Hey, how much inflation in Kazakhstan? Yeah, because if you don't discount this for inflation, what happens? The money you made, Chanel, in the project are eroded. So you think you have 25,000 in the pocket, but actually you don't have. Why is so? Because 4 years ago, before beginning the project, you could have buy, 20 bicycles. Now you can buy only 5, right? This is inflation. Okay, average inflation in Kazakhstan nowadays is 12.3%, right? In Germany, if I'm not mistaken, is 2%. Okay, now imagine minus 12.3%. 25 minus 12, how much it is? Yeah, you have only an average of 70, yeah, let's make it round. Let's make it round. And you have average of 18%, right? So you see how important is discount for inflation. Chanel, did you understood up to now?
Yes. Yes, I understand.
Perfect. So once again, guys, it's very important that before running any project, you make sure you discount for all these risks and never try to just believe in everything is selling in the market, because yeah, this is something very dangerous. Now let me share with you another screen.
1 second, Igor, while you're sharing another screen.
Please.
What if I am investing in a project that is not bringing any income during construction? With real estate, I can sell off plan, but let's say I'm investing in a project where I don't get any money during construction. How is the risk graph going to look like?
Yeah. Look, first of all, you need to be ready for the following. When you are investing in off-plan properties, you're heading to the capital gains game, okay? So you need to be aware that from the off-plan, you will get only capital gains in the future. At the end of the project, you don't get any cash flow. You cannot rent out, you cannot use yourself, okay? You can only wait. But, of course, there are many instruments how you can squeeze your equity from the project by selling during the off-plan, or what you can do, you can go to a bank and say, okay, I would like to now refinance this off-plan project. And depends on the country, not every bank in every country allows it, because the banks understand, they are not stupid. The risk is huge during the off-plan, and they might say, no, I wait until the project is finished. Did you because, for example, in Moldova, if you go to a bank and say, okay, I have bought one apartment and will be ready in 4 years from now, can you please give me a loan? They'll say, no, we will wait until the moment, this is in a classical way. But of course, there are banks which allow to finance under several conditions, and they will just give you a piece of money. So answer to your question, is possible? 2 options. First, you take out the equity by selling your position in the off-plan apartment. And number 2, you are going to the bank and try to refinance this investment, and the loan you receive is your equity and you can use it, okay?
Okay.
By the way, in many countries, big investors, they are not getting paid a lot of salaries. What they're doing, they're getting loans against the assets, and the loan is not taxable event. Okay, so and maybe you should also think about this strategy. So I have here a slide on my presentation. This structure shows another very interesting instrument, which is called Export Credit Agency. Many countries, for example, Germany, they provide this instrument. What this means? It's a very interesting tool, which means that if you develop, let's say, a data center, right, in a country, and Germany is the producer of chips, servers, and equipment for the data center, then the investor might consider to buy those equipments from Germany and not pay for it. Okay? Why? Because the German state is interested in encouraging the producer to produce more goods and export them outside of the country, right? And this agency is securing the deal in such a way that you as an investor, you buy this equipment to Moldova, okay? And you don't pay because the bank from Germany, is paying to the producer of the equipment, and the export credit agency, like in Germany we have Euler Hermes. I believe also in UK you have some kind of export credit agency. And those agencies, they get a small fee, and they make sure in case of event of default of the debtor, they pay the whole amount to the bank. Okay, so this is very, very interesting instrument which many investors are using. Okay, how much time we have now? We have 1 hour. Great, we have 1 hour. I will also, guys, stop a little bit by the topic of joint venture, because many projects are done especially with the joint venture. The joint venture is an instrument how you can make sure that the parties in the project, they are secured. Because, imagine you have, like I described in my project, you have a lot of parties, okay? Let's delete this, once again. In project finance, you have here sponsors, 1, 2, 3, 4. For example, Chanel, can you please update us on the following? How many investors can you have in a project in UAE registered in DLD department? Is there a limit or no?
I don't think there's a limit. One second, let me check. Sure.
Let's ask artificial intelligence, because we cannot know every jurisdiction. But imagine you have a couple of friends, and they trust you, they want to invest alongside with you. Now, you found a very interesting building with 10 apartments. They are providing a very good cash flow, but alone you cannot access this deal. So you would say to your friends, okay, let's invest together and put our names in the land department, in the cadastre, okay? Like it'll be 1, 2, 3, 4 owners of one building. Guys, I'm not speaking now about private houses, because I'm totally against buying a house before you have a good cash flow. And please go to my previous webinar, and you will see my position on this kind of investment. So first build the cash flow, and then you buy a house. Don't buy a house, a car, and then you don't have money to pay the diesel for this car, right? So first, access a building with apartments, with small apartments, which bring you cash flow every month. So imagine you wake up in the morning and at 8 o'clock, you look at your account and just dropping cash flow. Boo. Okay? And with this cash flow, you may build wealth. Okay? And from this cash flow, you can also separately use for your utilities, for rental if you cannot afford a house. But don't buy a house. Okay? I'm speaking now about commercial residential properties in which you can invest, rent them out, and get cash flow. So how many people can be in DLD? Did you find out? Okay, yeah. Yes. So imagine now we need to make a joint venture between all these people, right? How we secure the interest of every party? Because, for example, someone, I don't know, invested 100K, someone 200K, and then 300, and then someone maybe is rich, he invested 5 million, okay? So how you make sure that all these investors are secured through an agreement and they don't have any disputes in the future? Because someone may exit. Let's imagine after, I don't know, a few years, this one wants to exit. But the rest, they say, we don't want to exit. We will be comfortable keeping the capital in the project to make more capital gains in the future. So another situation is, let's say one is getting divorced and the wife says, you know what? I will sell the property immediately to enjoy my life. Okay? Another situation. Let's say one investor is, I don't know, getting ill and he needs a lot of money. And he says, okay, I also want to exit. I need money now, emergency. And let's say this one is passive, he wants to stay. Yeah. So the question is how you secure this kind of co-investment in a joint venture in such a way that everybody is satisfied. Okay? Aliyah, do you have any idea on this? On joint venture rights? How we can secure this? I mean, agreements is very simple answer, but what shall we think of in the beginning? Which kind of provisions we need to insert in the agreement in such a way that the joint venture partners are satisfied?
Help me.
Guys, anybody from the call? Anybody from the call is... So, guys, there are several points which might be considered when you draft a joint venture agreement. Because actually, what is joint venture agreement? Joint venture agreement is an understanding between different parties how they will behave in the future. First, contributions. Okay? So before entering into agreement, they will think and they will make in the draft of agreement the following chapter, contributions. How much, when exactly, and will be this contribution in money, in kind, might also be contribution in assets. Someone may come in a project with the whole furniture if he has a factory, or I don't know, or someone may come with his autos to provide services to the SPV. Yeah, so that's why first chapter is contributions. Okay. Now, second, in case of disputes, they think about who has right, how much, and why, and this will be voting rights. Okay. Voting rights means how much he contributed to the joint venture. If, for example, someone has 5 million, of course, he will have more percentage in the voting rights. And even so, you can have in joint venture different kind of rights, because it is, is the subject of negotiation. And some investors, they might say, okay, I'm comfortable with less voting rights, besides the fact I invested more money, but I want to receive more security and minimize risks. You understand? Or one of the partners may say, okay, I will manage these investments, okay, but you will get less voting rights in the GV, okay? Or, for example, do you know the guys which founded Google? There are two guys. These guys, they also applied so-called Dutch model of IPO, which is a little bit different than GV. But in the Google, even Meta in Facebook, Mark Zuckerberg, he doesn't hold a lot of shares in the company. If I'm not mistaken, we need to ask internet, but he holds maximum maybe 20-30%, and the rest are investors. But he still has more veto and voting rights than other investors, even they have more money invested. You understand what I mean? So voting rights are very important. Now, the second is voting. Then the third, the partners might also think of exit. So what is the exit strategy? So before signing GV agreement, they need always to agree on exit rights. Chanel, give me some example of exit rights you might think of, or strategies. If you bought the same building, let's say, yeah, what might be your exit rights if you are an investor? Give me your idea.
I think it all depends on the agreement in itself.
Yes.
Maybe depending on the percentage of my contribution or the value of my contribution.
Yeah, but
I can get this
exactly.
percentage.
Yeah, exactly. But I mean, exit. What could be your exit strategy if you invested in an off-plan building? What do you think? So what you will do after, let's say, you invested and after 4 years, you want to sell, or you want to rent, or you want to merge with other company. So what would be your strategy? And should you think about this in advance or not? What do you think?
You have to think about it in advance. I think what we were discussing before, like
Yes.
the risk factor comes in place very much. I think I would exit after I'm starting to get, after handover.
After handover.
Because that's when I make the most of my returns.
Yes. Okay, what another strategy might be? What do you think? I need to invite 2 other people, which they landed in another Zoom call. Just a moment. So, guys, our call was supposed today to be like 1 hour, but because we have different time zone, we'll also continue a little bit in another hour. But anyway, I will publish all of this, and you can later look in our live channels. And make sure you subscribe for the next webinar. So just keep in mind that we are doing this every Friday, and the topic is different. It's very challenging, interesting. And if you have any friends which would like to join, please feel free, please interact, ask as many questions you want, because we are here to help you for free. And I'll make a disclaimer now. We are not providing here legal advice, investment advice, or any kind of expert advice. what we are providing is free educational tool, and I'm explaining from my experience how I see different procedures, and I want to just help you with my knowledge. And if you would like to make any investments, okay, then you need to get in contact with experts, which they will advise you on every step, because we are not allowed to give you advice now in this Zoom call. So, okay, let's continue. Yes. So what else? Chanel, so the exit, which kind of exits you might have? Exit number...
Can I sell my units, for example, to another club deal kind of investor so that I can still have a return on it or a percentage, but then shift that risk to them?
Mm-hmm.
That makes sense.
Yes, of course. Of course. You can sell your position in the property every time when you decide. Important thing is that you look at your appetite of the risk and also which profile of reward you want to have. Because if you sell, let's say, before handover, remember this scale, before handover, and the risk is still high, and you are getting a good return, discounted, then of course you should do it. Okay? But if you have a better return, then better wait. Okay? I've met people also in different projects. They say, I need to sell urgently because I need money for something else. And I cannot take out this money. No, you can. Of course you can. You can sell your position before handover. The problem is which price you get for it and if you do the right calculations. Okay? So if any of you in this call has an exact case, I'll be happy to help, because there is individual case for everybody. But let's come back to our strategy. So exit number 1, strategy is sale. Number 2, what is number 2? We just wait, okay? So the exit strategy, we wait until we reach some KPIs. Let's say until we don't get a spread over these years for the amount of, I don't know, at least 25 per years. In the last 5 years, then we will not exit from this project. So this is exit strategy, which you outlined in the GV. Remember, you need to have a GV in place, okay? Which is joint venture agreement. Okay, and the last point, which is also important, are, what do you think, Chanel, what should be? Disputes, right? So, litigation. What if you get in trouble with all these investors and one of them say, okay, I don't agree, I don't like you anymore, okay? And they go in the court against you, okay? And if you are in an emerging country and you go to classical court, he might have friends in his court and you lose, right? That's why it's very important to choose a high integrity judges system, which might be free zone judges, okay? Free zone. Or arbitration. Why arbitration? Because arbitration, I would say, is also a very efficient tool. You avoid these classical popular courts in emerging markets, and you bring this case according to the substantive law. It depends which jurisdiction you choose. You decide on the appointment of the arbitrator, on the language, on the timelines, on the everything. So actually, in joint venture agreement, the litigation part should be at least 2 pages, outlining every kind of procedure you might encounter during these disputes. So, okay, guys. So this is the main structure of joint venture. I think we covered today a lot of interesting topics, and we had the goal to come with a very interesting approach how to secure your risk, how to mitigate different situations you might have in this kind of project finance. I would be happy to have you in the next calls and to discuss about also other topics. In the next ones, we will discuss something very concrete. We'll take a case study on the exact project. We'll bring a project from a real estate broker locally, and we will try to put on a screen and making like every point challenged in such a way that you understand what are the pros and cons of investing in different assets, businesses, real estate through project finance. So thank you very much for taking part in this webinar, and make sure you comment, subscribe, and like our channel. We'll be happy to see you in our next webinars. Thank you very much, guys, and stay safe.